Hello and welcome to American Property Partners. We're going to go ahead and get started right now. Well, I wanted to go ahead and just share with you, this is our webinar on briefly 9 cash flow killers that kill your U.S. property investment. So we're going to go ahead and get started with a video from one of our properties here in the U.S. and they are going to share with you just a little bit about the 9 cash flow killers. So it'll get started here in just 1 second. Here we go. Well, there you go. 9 cash flow killers. Craig just touched on them a little bit about area, and we're going to go and get started. So thanks again for joining our webinar this evening. In this webinar, we're going to discuss investing in the U.S. and the things that you can face and the challenges and the things that can hurt your U.S. investment property. So the purpose of this webinar is to accomplish 2 things. One, to provide you with value by sharing with you the 9 things you need to be aware of when investing in the U.S., and 2, to share with you how we approach each of those things to mitigate your risk in each investment. You know, I'll share with you, I've been selling real estate for the last 15 years. I've been to numerous sales courses over the years. You know, in every course they teach you the things to not talk about. They say, don't talk about religion, don't talk about politics, and don't tell horror stories of terrible things that have happened in your business or in your industry. So in this webinar, we're not going to cover religion or politics, but we will break one of the cardinal rules of selling. We're going to tell you the worst things about investment property. We may even try to scare you a little. We're doing this not because we don't want you as a client, but because we want you as an educated client, a savvy investor, one that knows the risks so you can appreciate the reward that comes with it. So without further ado, let's go ahead and get started. Well, as some of you may know, my name is Sky Mikesell, and I've been investing here in the U.S. for the last 15, 16 years now. I grew up here. I've invested in 5 states around the country. I bought over 500 properties, which I have personally renovated, leased, and managed. You know, despite my experience, even I get caught every once in a while by one of the 9 cash flow killers that hurt my investments. So today I want to share that experience with you. There's really no easy way for me to do that except by sharing the challenges with you that show you, how our experience here at American Property Partners kind of contrasts that, and sharing with you the intentional moves that we make to make sure you are going into a sound investment. So let's go ahead and get started. Location, location, location. If you have joined us in any of our recent webinars, you've heard those 3 famous words that are discussed in every conversation ever had about real estate. If you remember, we described location as location within the world, location within the country, and location within the city. Where in the world are you going to invest? Where in that respective country will you invest? And where in that city will you invest? The location has everything to do with your goals. Location is the reason you are on this webinar. Location can determine your financial future. It can determine the amount of cash you have when you retire, the caliber of your investment, the quality of your tenant. Location is absolutely everything. So let me share with you a story of 2 houses. So we'll get started. House number 1. Built in 2008, newer construction home, very nice looking, has good curb appeal or street appeal as we call it. The house on the right, house number 2, is an older brick home built in 1958. House on the left rented for $900 a month. House on the right rented for $850 a month. Both of these houses are 3 bedrooms, 2 full bathrooms, pretty similar size. And one house rented in just 3 short weeks. That's of course, the attractive house on the left-hand side. Beautiful vinyl siding, looks great, recently built, rented in just 3 short weeks. House on the right rented in about 4.5 weeks. All right, so what do you think so far? Which one would you be buying? Well, let me give you the prices. Well, the house on the left is selling for $74,000, and the house on the right, $91,000. A little bit of a price difference. So what's your guess? You may have guessed right. If you assume the house built in 2008, renting for $50 more per month, renting 1 week faster, and selling for nearly $20,000 less was the better of the 2, you assumed incorrectly. Maybe on paper, yes, it did look better. Maybe even the picture looked a little bit better. But let me tell you about these 2 houses. Both of these houses, they're real houses. One house sits in a location that is right on the edge of the worst areas in this city. The other house is a strong area that is experiencing tremendous capital growth right now, which is the house on the right, the brick home. There's a large difference between cheap and affordable. There's cheap houses all over, some in small towns, bad neighborhoods, mining towns. You can always find a cheap property. Cheap is different than affordable. A cheap property is relative to the market. A cheap property is normally indicative of an area that is part of a lower socioeconomic neighborhood, an area that you will experience more vacancy, vandalism, maintenance. A cheap property is much different than a property that is affordable. So how do you know what location is the right location? You heard our property partner, Craig, talk about it a little bit in that video. Location of the property that is affordable and not just cheap. All the signs are the same. The cars they drive, how they take care of their yards. When we are identifying these properties for all of our clients here at American Property Partners, we ruthlessly consider all these things. We cannot tell you what you should and should not be comfortable with, but we can tell you the signs of an area that is not doing well. We can help point to the things that we believe is the heartbeat of a neighborhood. We are looking for areas that are not areas that are areas that homeowners are attracted to, not just the tenants. Areas that offer good street appeal, that you'll be able to sell down the road. Again, location is everything. All of us have heard, never judge a book by its cover. Equally, we never, ever judge a property by its picture. We've got lots of options. We can always go in and find with Google Earth and drive up and down the street. We can take pictures of street views. We can count on the market knowledge of the folks living in the area, and we can look at some telltale signs of the property, such as, is it a dramatically low price? In Craig's video, he touched on the property he was looking at was $12,000 and renting out for an obscene amount of rent every month. That contrast is extremely abnormal. That is a polar opposite from even these two examples that really doesn't even serve it justice. I mean, on paper, these two properties look great, and only with looking through the neighborhood, if you drove up and down the neighborhood of this 2008 property that you're seeing on your left-hand side, you would find out very quickly by the way the yards are taken care of, by the cars that are driven in the neighborhood, by the condition of some of the houses in this area, that it was a new construction neighborhood built in 2008, right at the peak of GFC, and walked away from by the builder. And ultimately there's vacant lots in that neighborhood. There are houses that are boarded up over there, and it's just not a neighborhood that you'd want to be investing in. So that's what we're here for, is to help you through those sorts of things. So let's jump into one of the cash flow killers, the initial renovation. We have all hired contractors to do various projects for us. My good friend used to say about contractors, he was a contractor himself, which makes us funny. My good friend used to say, he said, the contractors are guys that come late, leave early, and steal from you when they are there. That is maybe a little bit of a pessimistic view, but also one many of us have experienced. We know projects always seem to cost more and take longer than planned. We know there's always something else that comes up. So handling a renovation when you are there physically near the property every day already comes with its own challenges. Handling renovations from afar comes with even more challenges. So here's the good news to start out with. When you are investing with American Property Partners, you don't have to deal with contractors, you don't have to deal with the project, you don't have to sit through a renovation on a house. All of the houses we sell have already been renovated. However, a renovation to you and to me can mean something completely different, so we need to ask. A renovation to some could simply mean new paint and new carpet. I had a client who bought a property from a group, and the group claimed they had just been, basically the house had just been renovated. They renovated with new paint, new carpet. The problem was the carpet was installed over a floor which was actually rotting, and they painted walls that had that were basically infested with termites underneath them. So how do we prevent this from happening? Well, we obtain building inspection reports on all the properties. We ask specific questions when they're looking for properties that have had more than just lipstick put on them. We're asking about the things that really, really matter. All of the mechanical items, the heat and air conditioning, water heaters, roofs, these are the things that will cost real money down the road. We're not concerned whether the house has been updated with paint. That's a bare minimum expectation these days. New flooring, so what? We're looking at the things that really will cost money down the road, and if they're not handled during the renovation process, they've got the potential to threaten your cash flow and frankly eliminate it if they were not handled properly during the renovation process. So we need to know how to look at all of the numbers on our property. So when we're evaluating property, we're looking at basically two primary numbers. Of course, we're looking at the purchase price and the amount of rent that the property is generating. These are the first two looks at every property. You look at these two to determine if you even want to bother looking at this property any further. The reality is, if the property is vacant, then it does not have a rental number. Okay. Let me say that again. If this property is vacant, then there is no way it can have a true and honest income number on it. How can we possibly evaluate a property that has no income? Yes, I realize all of us can take educated guesses. We can look at resources online, looking at other comparable rents, but we still don't know the true and honest number. The fact is, the only way to truly know is to make sure we are buying properties with tenants already living there or lined up to move in. Why would you buy any other way? You would never consider buying a property that only had expenses to offer and no income. So all of our properties in every city, the properties we work with our clients come occupied with tenants paying rent each and every month. No one is saying that these tenants are perfect or they're going to pay perfectly, but what we know is that they chose that property. They put a bond down that they could lose if they did not perform on paying the monthly amount agreed to. Now, and only now, do we have a true income number, a real number to work off of, to evaluate all of the expenses against to make sure the numbers actually work. So let's look at the other numbers that matter now that we have income actually coming in on the property. Such a great expectation. I recently was reading a real estate magazine published here in the United States, and in there it was advertising. There was an advertiser, and they're advertising a 34% annual return on capital invested. Astounding, right? What an awesome return, I thought. Now, I'm not a person that believes just because something is too good to be true that it's not real. I prefer to evaluate each investment for what it is and determine if it's bunk or if it's real. So as it turned out, this one was bunk. The 34% was real if you did not factor in the majority of the expenses that were going to be associated with this property. How do we know what our net number is? The net number after expenses. Look, you can come up with all the expenses you want. You can evaluate these investments any way you want. If you believe your spreadsheet that you made is the best creation.
Hello, Sky.
Hey, Stephen.
Oh, sorry to interrupt, but people in the chat room are saying, and I can see it myself, the slides aren't moving. I'm stuck on the first slide as well.
Okay, let me double check that.
You might not have seen the chat there. Oh, here we go. Thank you for everyone in chat who mentioned that. I just saw that myself. So Sky, we'll get it going again for you. Sorry to interrupt. I'll let you proceed.
Well, Chief, let me know. What slide are you seeing right now?
I'm seeing knowing the numbers.
Ah, that's bizarre. Okay. Okay. All right.
I think people get the drift though. Cool. Thanks, Guy.
All right. You guys,
right.
You guys missed some great slides. I might have to go back. All right. So, where do we start? That 34% was a real number, basically, if you didn't factor in all the expenses that were associated with the property. And so that's what we went back and did. So basically, how do we figure out what our net number is? Look, you can come up with all the expenses in your spreadsheet. You can put together the best formula that you think is in existence. And all that we ask in putting together, when you're putting together your numbers, that you use a consistent formula against each property. So let me share with you how we evaluate the investments. We look at your net return on investment, your ROI. This is your baseline comparison for how you're basically figuring out your US or your Australian real estate investments. If you had a family member ask you for a loan so they can start a new business and they offer to pay you, let's say 5% interest, then that is your return on investment. If you can invest in the stock market and make 6% after all your expenses are deducted out, then that is your return on investment. If you invest in real estate after you back out all of your expenses, what you are left with at the end of the year, that is your net ROI. So this is your baseline comparison for all investments you're moving into. So now you can move forward confidently knowing you're investing your money in the investment that will provide you the highest return on investment with the same balanced risk. So let's get to that ROI number, and it might be a little bit, as the evening approaches, it might be a little bit late for a math lesson, but we'll do our best. So we add up all of your expenses, everything that you can come up with, the mortgage on the property if you get financing for it, your property taxes, which is your council rates, insurance, property management, body corporate, vacancy, maintenance cost, whatever, all of the expenses that you could possibly come up with, we add those up, and whatever is left at the end of the year is your cash flow. So once you have your cash flow, then we go ahead and divide that into the number that you actually invested, not the total number of the purchase price, but the number that you actually invested in the property to get your return on investment. So for example, if you invested $50,000, then you figure out what your net cash flow is after it's all said and done, and that's and you divide that against your $50,000 investment. That's how you get your ROI. So we run these numbers with you. I don't need you to have a calculator out right now. We run these numbers with you and for you for every single property during the property evaluation process, regardless of the city, regardless of the age of the property. These are the baseline numbers that we're running right alongside of you to make sure these investments are proper and valid investments. We need to know what our net return on investment is. This is something that we can rely on, and this is something that we can build our portfolio around. So one of the cash flow killers that I'm sure we all love to talk about is property management. Property management is one of those expenses that, frankly, there needs to be a slight paradigm shift. You know, I'm sure it's tempting when evaluating property to use Australian management fees as a guide, but when you're reviewing available property from American Property Partners, you'll see in all the properties the management fees typically range from 8% on the low end all the way up to 10%. This is very standard fare in the U.S. These fees basically pale in comparison to having the wrong property manager in place. The performance of the property manager that is involved in your property in almost every single case, directly or indirectly, relates to the ability basically relates to the performance of your property. A property manager determines the tenant who moves in there. A property manager determines the protocol for rent collection, maintenance, inspections, and in some cases even the caliber of the tenant. You know, we worked hard vetting out each property that we're working on. The systems and processes they have in place, we're looking at those of each property manager. You know, none of them are perfect, but all of them know how to basically effectively manage rental property. At American Property Partners, you know, despite our efforts in finding you the perfect property manager, we believe it's still your job as the diligent investor to manage the property and to manage the property manager. If you're not clear, ask the questions. If your property manager is not clear, ask more questions. If there is maintenance, understand what the maintenance is for. So each and every one of these things, we believe that at the end of the day, it's your job to manage the property manager. This is not to be skeptical or to think that something dubious is going on, but merely to keep clear lines of communication open at all times. So again, we're managing the property manager. So our cash flow killers, property tax, council rates. You know, in the U.S., rates are very similar to Australia. They widely vary between states and counties. It basically cannot be assumed because you pay a certain percentage in one state that it'll be the same in another state. What we find is if there are certain states with higher property taxes, the income on the property will be proportionately higher to compensate for the higher taxes. Property tax in each state can change depending on the state. Every few years they can reassess the value of the property, and this is a standard property tax in the U.S. We don't have what I believe you refer to as tax duty or tax stamps, transfer tax. However, it's referred to. We don't have that here in the States. What we have is we've got property tax, which is similar to your council rates, but ours are, I guess, a little bit different in regards to percentages. They range on average anywhere from 1% all the way up to 3.5%, depending on the state, and that's of the value of the property that has been assigned by the state that the house is in. So, for example, in some states we're hovering right around a little over 1%, and in other states, you know, there's one particular state that is over 3%. in that particular state, property tax, property income, rental income is also proportionately higher, and to obviously compensate for those higher property taxes. So one of our cash flow killers is insurance. In the U.S., similar to what you may be used to, however, we have seen a couple of different things. We've seen basically poor insurance decisions turn really great investments into pretty big nightmares. Most of the things that are in insurance, there's some standard things that you get in every insurance policy. For example, what we refer to as kind of the burn down policy, just the bare minimum building policy. If something happens to that house, the insurance company and the bank rebuild it. There's the standard general liability insurance, the what we refer to as a proverbial slip and trip policies. And in that, you're missing a couple of vital things that insurance does have to offer. And if insurance was basically, you're looking at two particular things. One of those is the loss of rent clause. So let me just jump in and share with you a brief story. So about 4 years ago, I got a phone call. I was actually on my way into the office, and I got a phone call. It said, "Hello, are you the property manager for this specific address?" Yes, I am, I responded. "Okay, this is the Charlotte Fire Department, and we are over at your property over on River Street, and there's a fire here this morning, and we believe the cause was a small fan, and that fell over and caught the blanket on fire." So needless to say, I was a little taken back, and they said, "Well, actually, the second level of your home is now gone." And so it turned out this actually wasn't my home. It wasn't my rental property either. It actually belonged to one of our clients who, at that time, they had bought it. They had owned the property for about 4 years at that point. We had strongly advised them to pay for something called the loss of rent clause as an add-on to her insurance. The clause basically paid her. The loss of rent clauses does not come standard in every single policy. The loss of rent clause is basically an add-on to every policy. It's pretty inexpensive, a few dollars extra per month. But this basically what it does is it pays you the same rent that you were receiving on the property for the next however many months until the house is rebuilt. In her case, it took the insurance company and the bank, by the time they negotiated the amount that was needed for this property to rebuild it properly, it took 7 months to rebuild this property. In that time, she continued to receive her $975 in rent per month, every month for the next 7 months. And then on top of that, they gave her an additional 2 months to allow the property manager time to get the property leased. She would have been out thousands and thousands and thousands of dollars had she not had the loss of rent clause in place. And the clause itself cost roughly $15, $20 extra per month. Minimal compared to the cost that it would have taken had the clause not been in there. So as you can imagine, our client was grateful. She was grateful that we were pretty convincing in advising her to get this add-on to her insurance policy. The best part of this story, in my opinion, is about 3 weeks after the house burned down. Mind you, the whole second level of this house is gone. The tenant who used to live there called our office and requested that we send them back their bond, their security deposit. And we found it quite funny, and I simply responded. I said, "Ma'am, you have burned down the house. I don't believe we are going to be returning your bond. The house is no longer in the condition it was when we gave it to you, so therefore your bond is not being returned." Very simple. So that's where we're at. So repairs and maintenance. Repairs and maintenance is such an ambiguous term, and just to make sure we're all on the same slide, we're looking at a repairs and maintenance slide, or just a picture of a house. So repairs and maintenance is such a ambiguous category. How much is a right amount to set aside each month? Well, first off, repairs and maintenance are two separate words and two separate categories. Repairs meaning the repair of broken items, and maintenance meaning properly and proactively maintaining, basically maintain the property before anything goes wrong or before it needs it. As it relates to maintenance, a lot of the maintenance can be scheduled and planned for. For example, if you know you bought the property this year, and when you bought the property, it had a brand new air conditioning installed, then you'll need to probably plan on installing brand new air conditioning in about 12 to 14 years from now. That's the typical lifespan of an air conditioner. If the house has a brand new water heater, you can look at a new water heater anywhere from 15 all the way upwards of 20 years down the road. You can expect to replace a water heater. And so these are scheduled maintenance items that you can plan for. When you're buying a house, and we ask these questions as well as you can as well, which is, how old is the air con? And if they say the air con is 3 years, or you only got about 3 years of life left on it, meaning it's 10, maybe 12 years old, then this doesn't have to be a deal killer, but it can be a cash flow killer. What we help you factor in and say, you know what, that thing is 10 or 12 years old. Maybe we, work it out with the seller of that property to install a new aircon, or we help you build that number in to your maintenance plan, your scheduled maintenance plan down the road, so it doesn't catch you, 3 years down the road and say, oh my goodness, I had no idea I was going to be having to replace this brand new air conditioning. These are all easy to plan for in scheduled maintenance. So, as a general guideline for maintenance, we like to set aside 5% per month. These are some of what we like to refer to as kind of the break-fix scenarios as maintenance. If it's broken, we fix it, and this is general maintenance. For that, we set aside 5% per month. I personally, for maintenance, and this is my personal preference, I fund my own maintenance accounts. When I'm buying a property, I put starting out money in every single one of my maintenance accounts, and I add the 5% to that. That's my personal preference. We have some clients that prefer that 5% number for maintenance to be higher. Recap back to what I was speaking of earlier when we were talking about net return on investment and factoring in those expenses and your spreadsheet. There is no wrong number on maintenance. There is no wrong number on vacancy. You get to pick that number. We're not telling you what that number has to be. We run all of our numbers based on a 5% maintenance and vacancy rate. There is no absolute that you have to set it aside. If you want to use a 10% number, a 20% number, heaven forbid a 20% number, then that's okay. You can use that as long as the numbers still work for you. So use whatever number you want. So by setting aside that number, you're basically going to be prepared for that maintenance call to come in, and that's what is important. It's not the amount that you set aside. It's that you've got that peace of mind that at some point the property manager is going to call and say your tenant called and they've got a leaky faucet. Your tenant called and their door fell off. Whatever it is, you will be prepared for that call, and you're not going to lose sleep over it when you know that you've had a budget set aside for it. So vacancy is one of those numbers that nothing hurts cash flow more than zero income. That's what vacancy is. It's zero income. That means this is money lost, money you'll never frankly get back. When a property is vacant, it will already be something that you don't want to deal with. Basically, but however, what makes this vacancy tolerable is being ready for it. So plan and prepare for all of our properties. They will all eventually go vacant. So we're ready. We have an allowance. We like to, again, factor in 5% of our gross rent each month for vacancy. Our average tenant, depending on the city that we're in, our average tenant stays in most places for a minimum of 2 years. Some of them are 3 and 4 and 5, 6 years if we get lucky. And the average time, if the property was to go vacant, is about 45 days. And so we plan for that. So planning and preparation and an allowance for each line item, is what makes these investments more comfortable and easier to manage for you, and frankly for your property manager too. So look, we've covered a number of different things tonight that we refer to as the 9 cash flow killers. These are things that can hurt your ROI, your return on investment. there's many strategies that we can share with you on working through vacancy and how to discuss vacancy with your property manager. What are strategies we can talk about on how to monitor your maintenance, how to choose property. We just simply cannot cover everything with you in this sort of format, particularly when the slides are not moving. So what we shared with you, we hope will be the largest cross-section of information to help you invest in, to assist you in your investing decision. Let me share with you some of my closeout thoughts. My take is this: investing in anything is a risk. There's no such thing as a risk-free investment. If there was, we would all be on that train. Everyone you know would be investing in it. There's no such thing as a risk-free investment. In fact, I'll take it a step further and say, if someone tells you there is a no-risk investment, run. Run as fast as you can. There cannot be a return without a risk. It does not exist in any country or any type of investment. What makes each of you on here listening great investors is that you are taking the time to figure out what those risks are, evaluating those risks, and making sure those risks are at an acceptable level for you to warrant the type of return that you're wanting to get here in the States that you cannot get in Australia. So where do we begin? Well, to get started with American Property Partners, we always say just make your location decision. So your location decision is where in the world are you investing? Location, location, location. We've talked about it from the beginning. From there, set up a one-on-one call with either Stephen or myself, where we want you to finalize your investment criteria. We're not going to tell you what your criteria should be. Some of our clients have a criteria of return on investment. Some of them have a criteria of age of property that is the most important to them. Some of them have a criteria that the location has to be a predominantly owner-occupied neighborhood. This is your criteria. We want to understand what it is so we can fit the properties that fit your specific criteria. And from there, we'll identify a few properties that fit your criteria that you like, and we want you to share with us why you like those properties. Then after that, we set up a property, what we refer to as our property selection process, and we review those in basically great detail. We start the financing process, and then from there you get to begin building your investment portfolio. So that brings us towards the end of our webinar. We'll go ahead and open up for questions now. So I'll share with you just briefly before we open up for questions. We've got a workshop there in our office in Melbourne on June the 4th at 7 p.m. And this is basically how APP can help, American Property Partners can help, what locations you should be looking at and why, typical properties for sale, the rehab process, tax and ownership structures. This is a great workshop. This really gives you a little bit more in depth to our webinar, and covers even a few more things that we could not cover here that you're going to be thinking about. So I'm going to go ahead and open up for questions. You're welcome to go ahead and chat questions in, and feel free to go ahead and jump in anytime. So I see all of your chats now. The slides are not moving. My apologies. All right, let's see. Let's go and open up and see what kind of questions we got. Okay, so one of the questions we've got typical timelines on vacancy. So again, to kind of recap on vacancy, it's based largely on the areas that that you're going to be investing in. We're in a handful of different states and different cities around the country. Each one varies. What I can share with you is that property management vacancy rates 1 year ago were roughly at 11%, and actually closer to 18 months ago we're at 11%. Since that time they've dropped down to 9%. Most property managers that we deal with are running anywhere between a 5 and a 6% vacancy rate. Some of our really great property managers are hovering at 3%. Our Orlando group is hovering around 3% for property management. Our Texas group is hovering around 3% for property management. So every manager is a little bit different in regards to what their vacancy rate is. So that's it for vacancy rate. Good question. Lori, your question, what states do you recommend? Here's the deal. We are only in states, this might sound like a very canned answer for you, but we are only in states that we recommend. We're not buying in areas that we personally would not buy in. There's a lot of places, 226 major cities in the United States, all of which you can invest in, all of which you can find probably a quote-unquote cheap property in. Not an affordable one, but a cheap one, one that is going to surely come with a couple of those cash flow killers that we discussed. So I'll do my best to give you a canned answer with experience. So Forbes magazine, 2014 version, came out and basically cited 4 of the cities that we're investing in as amongst the top 10 cities to invest in, and of those 4 cities, all of them were within the top 6. So out of 6 cities, we're investing in 4 out of the top 6. The other 2, I'm not sure why Forbes put them on their list, as they're not markets that are basically where the numbers work. They might be good places to invest, but the numbers from a cash flow standpoint just don't work out. So where Orlando is strong, Charlotte is strong, Houston, Texas is strong. Most of the Texas markets are strong. We've spent a lot of time finding the property and finding the property managers, which is nearly as important as finding the property. There are markets that we are currently vetting out. One of them is in Texas, and our main focus right now is making sure the property manager is up to snuff to be able to manage our clients properly and understand their protocols and systems in place. So good question. Thanks, Lori. Jason, you asked how long does it take to establish a U.S. loan? U.S. financing for international investors has been very tricky in the past. There was not a lot of lenders doing it pre-GFC. Post-GFC, almost all of them disappeared. We're fortunate in the fact that we have Peter in our office and Stephen in our office who have worked really hard establishing. Stephen has been all around the United States establishing relationships with individual banks and private small banks, lenders across the U.S. that are willing to do the loans. All of their criteria is different. We typically say you plan on 45 to 60 days to get through the entire process. This is a pretty interactive process, and the weight and the work is on you to get everything together. And so we work hard and closely with the lenders, and basically are an advocate and present your package to them for financing. And we've had a tremendous success getting our Australian clients financed, and I believe we're one of the few that can finance. So thanks for the question. Sonny, one of your questions was what are the primary channels for us to source properties? All of the properties, in order to actually add value to these properties, they have to come in somewhat of a distressed asset. If they're coming from a homeowner, more than likely the houses would already have been in relatively decent condition, but maybe not renovated, updated with mechanical items that we talked about in the way that we're wanting to see them. So most of our property partners in each respective city, they're working with banks directly. Most of them have relationships with local lenders that are handing them properties. I will tell you, the properties have become challenging, are getting challenging to get. It's the secret is out. Investing in real estate is a good idea. I don't know who told these hedge funds that this was a good idea just now, but they're on to it. And so the bottom line is, we've been at this long enough. We've got great relationships with every city that we sell property in, so we've been able to maintain a good flow of rental properties and not had to, our prices have not risen dramatically. The rents are still making the numbers work out. So our properties get sourced through a variety of channels, but hopefully that helps. Majority of them are coming through banks. So good question, Sonny. Thanks. Rob, your question was, who would we recommend for property insurance? There's no general one-size-fits-all answer for that. Property insurance is going to range from state to state. I will tell you, for example, I live in Charlotte, North Carolina, and in North Carolina, it's in the United States, they refer to this as a brick and mortar state, and for lending and for insurance, and meaning the agent who's writing you in the insurance has to be in this state, living here, have an office here. And so North Carolina is unlike other states in that regard. And most of the insurance agents that you're going to find it's going to be best finding them on a per state basis. Our property partners are going to be able to refer you to a couple of different agents. We can call, speak with them. You can call and speak with them and find the one that you're comfortable with that's providing you a fair rate. And then from there, basically all the insurance companies are similar to grocery stores. You can get the same products at each insurance company. The prices might change just a little bit from one to the next. The service might change a little bit from one to the next, but ultimately you're basically shopping at the same store, just with a different card. So we've got a couple more questions coming in. So let's see, is that a question from you again? So what's a rental yield considered as a good yield on a typical 3-bedroom and 4-bedroom properties? So again, this is going kind of back to return on investment and how you're factoring in your ROI. I mean, we've got numbers coming in anywhere from net returns anywhere from 1% all the way up to 7 or 8% on the high end. That is for those of you that are looking at the numbers, say, well, is that a gross number, meaning before expenses, or is that a net number, meaning after expenses? That's a net number. That's after we factor in your mortgage, your property taxes, your council rates. If they've got body corporate, we factor that in. We factor in insurance. We factor in property management. We factor in, again, a 5 and 5% maintenance and vacancy rate. So we're factoring in basically a number of, basically we're factoring in all of your expenses to come up with that net number. So that's basically all of it. So Lori, your question, what is typical interest rate charged by finance? Again, this ranges from state to state. There are certain states here in the U.S. that we have very, very favorable financing in, and then we've got some lenders that will finance in every state. We've got other states that, and the lenders that will finance in every single state sometimes can be a bit higher in cost. We've got rates, and again, this is not a one size fits all, but and this is not again a kind of a paradigm shift from Australia, but rates on investment property here can range anywhere from 6% on the low end all the way up to 12% on the high end. So yeah, that's basically it. So hopefully that answers your question, Lori. And the rates again, they vary from property to property. So let's see, Jason, you're asking, is there any rental guarantees available? So every property, this again back to city and state. So they will go all over. We've got some providers, yes, that will offer rental guarantees on the property. What we find oftentimes with rental guarantees is ultimately we're after making sure the property is in the right location, the property management is there. I mean, we've heard horror stories from other clients that have bought from other companies that have chosen to work with providers that have provided 3-year rental guarantees. There's one particular group providing a 3-year rental guarantee. Well, why were they providing that? And was my first question. Why would anyone provide a 3-year rental guarantee? Frankly, it's suicide for the company that's providing it, because that just opens up too much exposure on 100 property portfolio. But more importantly, why would they need to provide a 3-year rental guarantee to entice clients to buy in their market if the numbers worked out? Well, it happened to be an Ohio market, where Ohio is basically Cleveland, Ohio, where the numbers looked good on paper, but not a lot of people were initially buying there, and so they were offering a 3-year rental guarantee on their properties in order to entice people to get there. Well, ultimately what happened is they went out of business, and those 3 people with 3-year rental guarantees on properties in low socioeconomic neighborhoods were now on the hook for those properties. And moreover, what it allowed the property manager to do was to cover up the fact that some of the properties were in fact vacant. Whereas when there's not a rental guarantee on a property, when the house is vacant, and it's one of your first telltale signs there's something going on over with that house. And anytime there's anything happens on your property, you want to be the first to know about it. This is your investment. It's your job to manage the property manager. So that's my answer for that one. So any other questions? I think we've covered a fair bit here. I've held you for 52 minutes, and so well, I will go ahead and wrap up here then. Yeah, again, we've got our workshop coming up on the 4th of June at 7 o'clock there in our office. And we also have a tour coming up in July. And so we just finished off a recent U.S. tour. We had a couple of clients on that tour, and it was a great tour. We visited 3 different cities and got to get through a handful of properties, met property managers and lenders and accountants, and it was a great tour. Got to see a lot of property, a lot of different properties, and by doing the tours, firsthand what's going on in these areas, and you go back if you feel remotely comfortable just with the information that you're gleaning and getting on your own from being in Australia and not being here, then you're going to feel 100 times more comfortable actually getting to see the properties. I realize that's not an option for everybody, and so we'll spend the time with you on the phone. So again, my name's Sky. You can talk with myself or Stephen.
Sorry, Sky.
Yep.
It's Stephen here. Sonny just had one late question.
Oh, I see that. Thanks, Sonny. So yeah, again, you can kind of finish up with either myself or Stephen as it kind of comes to one-on-one. So we'd be happy to talk with you. So I'll answer Sonny's last question. Let's see here. Why would there be distressed houses if they're all in good neighborhoods? The probability should be low. Obviously, for those of you who've been asking if this webinar is live, I wouldn't read a question like that if the webinar wasn't live. So again, Sonny's question is, why would there be distressed houses if they are in good neighborhoods? The probability should be low. I think that's I always find that to be an interesting question. So let me answer that the best way I can. Pre-GFC, everyone always came to me and said, why did GFC hurt so bad? Everyone says, oh, well, the amount of foreclosures went up dramatically. Well, the fact is they actually didn't go up dramatically. The amount of foreclosures went up to 12%. Banks, when they are loaning, banks are expecting a 10% default rate. Foreclosure went up to a 12% default rate. That's not a huge jump. That's not enough to put these big banks under. Bank of America, Chase, Wells Fargo, these are big boys. They're not going to be put out by a 2% increase. What hurt GFC was the fact that houses had lost value, $100,000, $200,000, $300,000 in some parts of the United States, mostly on the West Coast and the upper Northeast where we don't buy properties. And so banks count on a 10% default rate. So, don't misunderstand me when I say distressed houses. Distressed means foreclosure. Banks count on a 10% foreclosure, and that doesn't necessarily mean the house has to be in a bad neighborhood to be foreclosed. There's houses on the street that I live on that have been foreclosed, and I don't live in a bad neighborhood. And so a 10% default rate is expected. Distressed means anything the bank has taken down. Distressed means that anything that needs work. There are banks here that will not finance properties if the carpet is so much as dirty, because banks only financed houses that are in perfect condition. And so therefore, the only people that can buy these houses that need any amount of work, whether it's just simply air conditioning, carpet, fresh paint, whatever it is, banks won't finance homeowners to buy those, which means the only option for them is investors, and investors like the partners that we work with generally go in and pay cash for their properties and then fix them up on their own dime to the point that they're ready to go for financing again. So that's a good question. Hopefully it answers your question there, Sonny. So
I think Sam's got in for the last one, Sky. One more.
Oh, Sam. Oh, Sam, you're a sneaky fella. Sam, you snuck in. How do we pay property and personal taxes in the U.S.? Do we get assistance? Yeah, we've got. I'll give you a couple of answers there. So property and personal taxes. A lot of this will be covered in our upcoming workshop on June the 4th, but basically, you'll have an entity set up here. We have an entity structure here, like a corporation, called an LLC, and working with American Property Partners, we've got our in-house sister company, International Portfolio Group, which will help you set up your entity structure, bank accounts, a whole bit, and that's how you'll handle all of your basically all of your taxes here in the U.S. And obviously, the only taxes that you're really going to be dealing with on this side of the pond is going to be as it relates to your property. So just like any general ledger or accounting would go, you would have income line item for the income that you're receiving, which we hope for you is lots on your rental property. Then of course you're going to have your expenses, which we hope for you is minimal. We already know what those expenses are: your mortgage, body corporate, council rates, taxes, insurance, property management, all of the expenses that come with the property, and whatever is left over is obviously what taxes is paid on. So we've got a great accountant here, a great accountant over there in Australia that you can talk with. But yeah, we can walk you through that process. This is I will not deceive you in any way. It's not a simple process. It's for you to kind of jump in and do it on your own. It is pretty complex, dealing with international tax law and how to structure things properly here in the U.S. But we've been through this countless times at this point and have a ton of experience doing it. So yeah, we'll be able to walk you through all of it. So I think that's it. I think that's it for now. Sam, great job on getting the last question. I've held everybody exactly for 1 hour. And I appreciate you joining the webinar. This is a series of webinars that we'll be doing, so keep an eye out for our next one. And I would welcome you on my side of the pond anytime you want to come. Even if it's not for an official tour, I'd be happy to give you an individual tour if you want to make it over. So come on over anytime. Look forward to having you. Thanks again, and cheers. Have a great night. Bye-bye.